Have you ever found yourself staring at a company's earnings report? It feels like trying to read a map in just, well, dense fog, right?
Oh, absolutely. It's just this wall of numbers and jargon. It can be really tough to figure out what's actually going on.
Yeah, you feel like you're missing the real story. These reports have crucial stuff in them, but, without the right context, it's easy to get lost or just focus on the wrong headline.
Totally agree. And you're definitely not alone in feeling that way.
Exactly. And that's why we're here. This deep dive is all about cutting through that fog for Tesla's Q2 2025 earnings. We've got this comprehensive analysis report that's our source material, and our mission today is to pull out the really important bits for you.
We want to give you a clear picture. How did Tesla really do? What were the big factors impacting them? And maybe most importantly, what's management signaling for the future?
We're going beyond just the headlines to give you that context, those sort of aha moments that help you feel truly informed.
And to do that, we're going to use a 5-part framework, just like the report we're looking at. It helps break things down systematically.
Think of it like getting a backstage pass to their financial story, not just reading the press release summary.
Sounds good. Let's dive in.
All right, now for slide 1, the at-a-glance scorecard. So this first section, it's designed to give us that quick snapshot, right?
Yeah.
How did Tesla do versus what the market expected?
Yep, the big headline numbers. And right off the bat, what really jumps out is a pretty noticeable slowdown compared to last year.
Okay, talk us through the key numbers then.
So for Q2 2025, Tesla's total revenues landed at about $22.5 billion. That's $22,496 million to be precise.
$22.5 billion. And how does that compare year over year?
Well, that's down almost 12%, 11.8% actually, from the $25.5 billion they reported in Q2 of 2024. So a significant drop in their overall sales, that top line number.
And I assume that drop flowed down to profits.
It sure did. Their net income, calculated using GAAP, that's generally accepted accounting principles, also took a hit. It fell to $1.17 billion, roughly, down over 16% from the $1.4 billion a year ago.
Okay, and on a per-share basis, that's often what investors focus on.
Right. The GAAP diluted EPS earnings per share was $0.33. That's down even more sharply, about 17.5% from $0.40 last year.
Can we pause there for a sec? Why the focus on diluted EPS specifically?
Good question. So basic EPS is just the net income divided by the average basic shares out there. But diluted EPS is more conservative. It considers what would happen if all things that could become shares, like stock options or convertible debt, did become shares.
So it gives a sort of worst-case scenario for how diluted the earnings might be for each existing share.
Exactly. It gives investors a fuller picture of the potential claim on earnings per share. In Tesla's case this quarter, the number of diluted shares actually increased slightly, from about 3.48 billion to 3.52 billion.
Okay, so that $1.17 billion profit pie had to be divided into slightly more slices.
Precisely. Which is why the EPS figure dropped just a tiny bit faster than the total net income figure. It's a small nuance, but important.
Got it. Okay, so that's the performance itself. How did it stack up against Wall Street expectations? Was this a surprise?
Well, it was definitely a mixed bag. On revenue, that $22.5 billion number actually missed the analyst consensus estimate, which was closer to $22.8 billion. So a slight disappointment on the top line.
Okay, a miss on revenue. But what about EPS? You said it was mixed.
Yeah, this is where it gets interesting. For GAAP EPS, the official number analysts were expecting around $0.29. Tesla reported $0.33. So on that front, it was actually a beat.
A beat on GAAP EPS.
But most analysts also track non-GAAP EPS very closely. This is an adjusted figure where companies exclude certain items to show what they consider their core operational performance.
Right, the company's preferred view, essentially.
Kind of, yeah. And the consensus estimate for non-GAAP EPS was $0.43. Tesla reported $0.47. So against that widely watched metric, it was a miss.
So, beat GAAP, miss non-GAAP, miss revenue. Definitely mixed signals. Okay, so let's unpack why. Why did profit, net income, and EPS fall so much faster than revenue?
Now we get into the really interesting stuff. This divergence tells us a lot about the company's operating mechanics. The main reason is something called operating leverage.
Operating leverage. Remind us quickly what that is.
Sure. It relates to fixed costs. Think about a factory. Rent, basic staffing, those costs stay pretty much the same whether you make 100 cars or 1,000 cars. When revenue falls, like it did for Tesla, those fixed costs get spread over fewer units sold.
So the cost per unit goes up.
Exactly. The report calls it lower fixed cost absorption. It means each dollar of revenue is supporting more fixed costs, which directly squeezes profit margins. So leverage worked against them this quarter.
And wasn't there also mention of increased spending?
Yes, that's the other piece. The report notes that increased operating expenses, specifically a big jump in R&D, also put downward pressure on profits. We'll dig into that more next.
Perfect transition. Moving to slide 2. The engine of profitability. This is where we look under the hood, right?
Yeah.
How efficiently is Tesla making money? What are the margins telling us? And what's this GAAP versus non-GAAP stuff really about?
Exactly. Margins are like the efficiency gauges. Let's start with gross margin. Tesla's total GAAP gross margin in Q2 2025 was 17.2%.
And how does that compare?
It's down from 18.0% in Q2 last year. Not a huge drop, but it tells us that the direct costs, materials, labor to build the cars, and energy products are eating up a slightly bigger slice of each revenue dollar.
It's a 17.2% gross margin. But then the operating margin, that looks like a much bigger drop.
It really is. Operating margin plummeted to just 4.1% this quarter, down sharply from 6.3% in Q2 2024.
Wow. So let me get this straight. For every $100 in sales, a year ago they had $6.30 left after direct costs and operating costs like R&D and sales. Now it's only $4.10.
That's right. It's a significant squeeze on their operating profitability, and it really begs the question, why such a dramatic fall?
And the report gives us a clue, right?
Yeah.
It points to a strategic choice.
A very deliberate one. The gap between gross margin and operating margin includes those operating expenses, selling, general and administrative (SG&A), and crucially, research and development (R&D).
And R&D was the big mover.
Massively.
Yeah.
R&D expense surged by 48% year over year. It went from about $1.1 billion last year to nearly $1.6 billion this quarter. Management specifically linked this huge increase to investments in AI and other R&D projects.
Okay, so they're consciously choosing to spend heavily on future tech like AI and robotics, even if it hurts their operating profit today. That sounds bold.
It's definitely a high-risk, high-reward strategy. They're essentially signaling we're investing heavily in our future, and this is the near-term cost.
Which brings us back to that GAAP versus non-GAAP distinction. Why do companies even present these adjusted non-GAAP numbers?
It's their attempt to show investors what they consider the underlying or core performance of the business. They exclude items they argue are non-operational, non-recurring, or non-cash to provide, in their view, a clearer picture.
So what did Tesla adjust out this quarter to get from their GAAP profit to their non-GAAP profit?
Okay, their GAAP net income was $1.172 billion. To get to their preferred non-GAAP net income of $1.393 billion, they made two main adjustments, net of tax effects.
Adjustment 1?
They added back $443 million for stock-based compensation, or SBC. This is where employees get stock or options as part of their pay. It's a real expense under GAAP, but it doesn't involve a cash outlay right now.
So management takes it out to show cash-based operational performance.
That's the argument, though it's worth remembering that SBC does dilute existing shareholders over time when those options are exercised.
Okay, makes sense. And the second adjustment?
They subtracted a $222 million gain related to their holdings of digital assets, think cryptocurrencies.
So because crypto prices can swing wildly and aren't part of making cars, they take those gains or losses out.
Exactly. They want to show performance without that volatility. So adding back the non-cash SDC and subtracting the non-core digital asset gain gets them from $1.17 GAAP to $1.39 non-GAAP profit.
So by doing this, Tesla's management is basically guiding investors. Focus on this non-GAAP number. It better reflects our core hardware business, setting aside compensation structures and crypto bets. It's their narrative control.
Precisely. It frames how they want their performance judged.
All right, let's move on. Now for slide 3. The engine room business segment performance. This is where we really break it down, right? A company like Tesla isn't just one thing.
Absolutely. You have to look at the different parts to see what's really driving the overall results, which segments are pulling their weight and which might be dragging.
Let's start with the big one, total automotive. Still the heart of the company.
Well, yeah, by far the biggest chunk of revenue. But as we saw hinted earlier, this is where the main pressure is. Automotive revenue came in at $16.66 billion, down 16% year over year.
16% drop. Ouch. So that explains most of the overall revenue decline. What about profitability in automotive?
The gross margin for the automotive segment was 17.2%. The report mentions this is being squeezed by several factors. pricing pressures in the market, a shift in the product mix, maybe selling more Model 3Y versus higher margin SX, plus things like import tariffs and logistics costs.
Okay, so automotive is definitely feeling the heat. But then there's the energy generation and storage segment. That seems like a different story entirely.
A completely different story this quarter. It's fascinating. While its revenue actually dipped 7% year over year to $2.79 billion, they said due to lower average selling prices, ASPs.
Its profitability soared.
Exactly. This segment delivered a record gross profit of $846 million. If you calculate the gross margin on that, it comes out to a stellar 30.3%.
30%. That's way higher than the automotive segment and the company average.
Miles higher. It really raises the question, is the energy segment, quietly becoming this super profitable powerhouse within Tesla? It seems like it.
And the report suggests more growth potential there, too.
Yes, especially as they ramp up production at facilities like the Megafactory in Shanghai, which makes their large-scale battery storage units. This segment's contribution could become increasingly important, offering a strong counterweight to the automotive pressures.
Very interesting dynamic.
Huh.
Okay, what about the third piece? Services and other.
This includes things like vehicle servicing, repairs, supercharging revenue, merchandise, insurance. Kind of a catch-all.
How did that perform?
Pretty well, actually. Revenue here grew a healthy 17% year over year to just over $3 billion. It's a reliable growth driver, helping to offset some of that automotive decline.
And its profitability.
The gross margin is more modest, around 5.4%, but the report notes profitability improved, helped by increased supercharging usage as the Tesla fleet grows globally. It's becoming this stable, expanding revenue stream. Maybe not flashy, but important.
Yeah, kind of anchoring things while automotive fluctuates. Okay, let's shift gears. Moving to slide 4, financial strength and shareholder rewards. This is the health check, right? Do they have the financial muscle to fund all this R&D and expansion we've been talking about?
Exactly. We look at the balance sheet, what they own versus what they owe, and their cash flow.
So how does the balance sheet look?
Pretty darn strong. As of the end of Q2 2025, they reported total liabilities of about $50.5 billion and total stockholders' equity of over $77.3 billion.
Okay, so if we do the math on the debt-to-equity ratio, liabilities divided by equity, that's around 0.65.
Spot on. $50,495 million divided by $77,314 million gives you 0.65.
Oh.
And generally, anything below 1.0 is considered healthy, meaning the company uses more equity than debt financing. 0.65 is quite conservative.
So that gives them a good cushion financial flexibility.
Definitely, a strong foundation. Now let's look at liquidity, the cash they have readily available.
How much cash are they sitting on?
A lot. They ended the quarter with a hefty $36.8 billion in cash, cash equivalents, and investments. That's a huge war chest. And management specifically said they have sufficient liquidity to fund their roadmap, expansion plans, and other expenses.
Okay, so they're flush with cash, but then I look at free cash flow, FCF. The report says it was just $146 million this quarter. That seems tiny compared to the $1.34 billion in Q2 last year. What's going on there?
Yeah, that's a stark difference, and it's really important to understand why. It's not because their operations suddenly stopped generating cash. Cash flow from operations was still healthy at $2.54 billion.
So where did all that operating cash go?
It was almost entirely consumed by massive capital expenditures, CapEx. They spent nearly $2.4 billion, $2,394 million, on things like building out factories, buying machinery, investing in that AI infrastructure we talked about.
Ah, okay. So operating cash flow, $2.54 minus CapEx, $2.39 equals that tiny free cash flow, 247 or 146 base.
Exactly. It shows they're aggressively reinvesting almost every dollar generated by the operations right back into building the future of the company.
So their strong balance sheet and huge cash pile are what allow them to make these massive investments, even when free cash flow temporarily shrinks near zero.
Precisely. They have the resources to fund this strategic push.
And related to that, any mention of shareholder rewards like dividends or buybacks?
Nope. Nothing mentioned in the press release. And that's very typical for a company like Tesla that's still in a heavy investment, high-growth phase.
Their priority is clearly reinvesting capital into R&D, new factories, scaling up things like robotics and autonomy.
Absolutely. The implicit promise to shareholders isn't cash payouts now, but rather future growth driving stock price appreciation.
Okay, that makes sense in context. Let's bring it all home. Now for slide 5. The road ahead management's outlook and key takeaways. What did management actually say about the future? And what are the core messages we should take from this whole analysis?
Well, management's tone was I'd say cautious, but also very strategically focused. They acknowledged the challenging and uncertain global landscape. No sugarcoating there.
And they're focused for vehicle production.
They said they're focusing on prudently growing our vehicle volumes in a capex-efficient manner. Reading between the lines, maybe not growth at all costs, but more measured growth while keeping spending in check where possible.
But the big message seemed to be about a shift in where profits will come from long term, right? Less about just the cars themselves.
Definitely. They explicitly stated they expect our hardware-related profits to be accompanied by an acceleration of AI, software, and fleet-based profits.
So they're framing the current squeeze on car margins as sort of a necessary bridge to get to these future, potentially higher margin software and AI revenues.
That's exactly the narrative. The car is the platform, but the long-term value is increasingly pitched as being in the software, the AI, the autonomous capabilities, the fleet operations.
And did they give any updates on products tied to that vision?
Yes. They confirmed plans for new vehicles launching in 2025 are on track, including initial production of that more affordable model in the first half of the year.
The long-awaited cheaper Tesla and the Robotaxi.
They specifically mention the purpose-built Robotaxi product Cybercab is scheduled for volume production starting in 2026. That's a key part of their AI and autonomy story.
Okay, so let's synthesize. If you had to boil down this entire Q2 2025 deep dive into a few key takeaways, what would they be?
Okay, takeaway number one. It was a truly mixed verdict. Not a simple beat or miss. They missed on revenue and the key non-GAAP EPS number analysts watch, showing that pressure on the core car business is real. But they did beat the official GAAP EPS, suggesting some cost control.
Takeaway 2 really gets at that strategic spending we discussed.
Right. The big drop in operating profitability isn't just bad luck, it's a direct result of strategy. That huge 48% jump in R&D spending is the cost of funding the AI and robotics future. They are actively trading today's hardware margins for a shot at tomorrow's software and fleet profits.
It's an expensive bet on the future.
A very expensive bet. Which leads to takeaway number 3. The strategic pivot to AI is now front and center. Facing a tougher EV market, Tesla is doubling down on the narrative that its real value is as an AI and robotics company. The Cybercab Robotaxi is positioned as the tangible proof of this seminal transition they talk about.
They're asking investors to look past the current car numbers and focus on that AI future.
That's the core message. And finally, takeaway number 4. Diversification is proving its worth. While automotive struggles, the other parts of the business are stepping up.
Like the energy segment.
Exactly. Record gross profit, that amazing 30.3% margin, and the services segment providing steady 17% revenue growth. These non-auto segments are becoming really crucial buffers, providing stability and significant profit contribution.
So putting it all together, the final narrative for Q2 2025 isn't just a simple miss. It's more like the financial logbook of a company in a really challenging but deliberate major transition.
Yeah. They're using their strong balance sheet as a shield to navigate a tough market while pouring money into this huge AI, robotics, and autonomy bet. The lower auto revenue, the squeezed margins, the tiny free cash flow, those are the very real, quantifiable costs of making that transformation happen right now.
So the central question for you, the listener, or for any potential investor really becomes, do you believe the promise of those future AI-driven profits is worth the very real pain we're seeing in the core hardware business today?
That's the multi-billion-dollar question, isn't it?
It really is. And hopefully, using a structured approach like this today, breaking down the report slide by slide, helps you move past just the headlines, see those underlying drivers, check the financial health, and understand the story management is telling.
It turns that dense fog we talked about at the start into something, well, a bit clearer, a narrative you can actually follow.
And here's a final thought to chew on. In an age where, let's be honest, almost every company throws around the term AI company, Tesla's earnings report gives us this rare, almost real-time financial view of what that transformation actually costs. Does seeing those numbers, the R&D spend, the margin impact, change how you think about companies balancing today's profits versus tomorrow's big innovation bets?
Something to consider for sure.
Okay, before we wrap up, the usual reminders. Please remember, this deep dive is strictly for informational purposes. It is not financial advice, investment advice, legal advice, or tax advice. Any investment decisions you make should always be based on your own thorough research, and ideally in consultation with a qualified financial professional who understands your specific situation.
And while we've made every effort to ensure the accuracy of the information presented, based on the source analysis report, no guarantee is provided. This analysis was generated by an artificial intelligence model, integrating data from official earnings releases with publicly available market data. You should always independently verify any information before making decisions based on it.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.